The specter of America's burgeoning national debt is hardly a new concern. Yet recent economic shifts and policy decisions have cast an even darker shadow on the nation's fiscal health. America's debt pile is not merely substantial, it's a monumental accumulation, exacerbated by successive administrations indulging in a pattern of significant deficit spending. Currently, the ratio of U.S. debt to its gross domestic product hovers around a staggering 123%, a figure placing it among the most indebted nations globally. This level of indebtedness raises serious concerns about the long-term sustainability of the U.S. economy and its ability to respond to future economic shocks. Disturbingly, prevailing economic forecasts suggest that policies enacted during the Trump administration are poised to amplify the already substantial $2 trillion deficit inherited from the Biden era. To provide crucial context, the deficit incurred in the preceding year under Biden represented an alarming 6.4% of GDP. This figure not only dwarfed the 2% average of other advanced OECD economies, but was also the largest within the organization, with the exception of Israel. This persistent pattern of expansive deficit spending underscores a fundamental imbalance in America's fiscal foundations, where government expenditures consistently outstrip revenues by a significant margin. This imbalance erodes the nation's financial flexibility and necessitates increased borrowing, further compounding the debt problem. While the narrative of America's unsustainable debt trajectory has permeated economic discourse for years, a sense of urgency has been reignited. Just months prior, Treasury Secretary Scott Bessent articulated an aspiration to curtail the deficit to 3% of GDP by the culmination of Trump's term. However, the ominous threat of recession, coupled with the recent surge in Treasury yields, the returns investors demand for holding U.S. government bonds, has placed an even more acute strain on America's precarious fiscal position. The increased amount of borrowing due to higher yields directly impacts the government's ability to finance its operations and service its existing debt. This confluence of factors has fueled renewed speculation regarding potential unorthodox workarounds the Trump administration might consider should the nation's debt burden become truly unbearable. Therefore, this analysis will delve into the multifaceted reasons behind the sudden exacerbation of America's debt crisis. Furthermore, it will critically examine why the allure of unconventional, quick-fix solutions is likely a mirage, fraught with peril for the nation's long-term economic stability. Understanding the underlying causes and the limitations of potential remedies is crucial for comprehending the gravity of the situation. America's fiscal landscape has abruptly taken a turn for the worse due to a confluence of at least 5 interconnected factors. Foremost among these is the recent and significant ascent of U.S. bond yields. Typically, during periods of economic turbulence, the cost for the U.S. government to borrow money tends to decrease. This is driven by a flight to safety, where investors liquidate holdings in riskier assets, such as stocks, and seek the perceived security of U.S. government bonds, thereby increasing demand and lowering yields. However, during the most recent episodes of Trump-induced economic uncertainty, this conventional pattern did not hold. Instead, Treasury yields paradoxically rose as investors seemingly reduced their exposure to U.S. debt altogether, perhaps signaling a lack of confidence in the nation's fiscal management or concerns about the potential ramifications of the administration's policies. While Treasury yields have since moderated somewhat, they remain elevated by historical standards, making it considerably more expensive for the U.S. to issue new debt and to service the staggering $36 trillion of outstanding debt. This leads directly to the second critical issue, the mounting burden of debt servicing. The U.S. is already allocating approximately $1 trillion annually solely to cover the interest payments on its existing debt, a sum roughly equivalent to the nation's entire defense budget. This massive expenditure on debt servicing represents a significant drain on government resources that could otherwise be allocated to crucial areas such as infrastructure, education, or healthcare. The inherent danger here lies in the potential for a debt doom loop. As servicing costs escalate, the government is forced to borrow even more simply to meet these obligations, which in turn leads to higher overall debt and consequently even greater servicing costs. This creates a vicious cycle that can be exceedingly difficult to break. The third exacerbating factor is the recent economic slowdown. The unpredictable nature of the tariffs imposed by the Trump administration has demonstrably undermined both consumer and business confidence. This erosion of confidence translates directly into reduced spending, investment, and ultimately slower economic growth. The International Monetary Fund, IMF, in its latest forecast, significantly downgraded its growth projection for the U.S. economy from 2.7% to a mere 1.8%, and now estimates a concerning 40% probability of a recession within the current year. Weak economic growth, let alone a full-blown recession, would place even greater strain on America's already fragile finances. A sluggish economy leads to increased unemployment, which necessitates higher government spending on welfare programs and simultaneously results in lower tax revenues as fewer people are employed and businesses experience reduced profitability. The fourth contributing element, the failure of significant public spending cuts. The ambitious DOGE initiative, which aimed to achieve substantial reductions in public spending, has thus far yielded negligible results. Furthermore, with the withdrawal of key proponents like Elon Musk, the prospects of this initiative gaining traction appear essentially defunct. A stark illustration of this reality can be observed in the daily outlays of the federal government, meticulously tracked and published by the Treasury. Alarmingly, data from this year indicates that government spending has actually surpassed that of any previous year, with the singular exception of 2021, a period marked by extraordinary pandemic-related expenditures. This persistent high level of spending, despite stated intentions to curtail it, further exacerbates the fiscal imbalance. The fifth and final reason for the worsening debt crisis is inflation. Largely attributed to the tariffs implemented by the Trump administration, the consensus among economists now points towards a significant increase in inflation over the coming months. For instance, Citibank has revised its forecast for headline inflation, now projecting a peak of approximately 4% this year, a substantial increase from the pre-tariff level of around 2%. While a moderate level of inflation can theoretically benefit a government that borrows in its own currency, as it erodes the real value of the debt over time, the Federal Reserve has explicitly signaled its intention to counteract higher inflation with higher interest rates. This policy response, while necessary to control rising prices, will have a dual negative impact. It will further inflate the government's debt servicing costs and simultaneously act as a drag on economic growth, potentially increasing the likelihood and severity of a recession. Given this precarious fiscal landscape, which was already concerning prior to the Trump administration's policies, the prospect of further deterioration is deeply troubling. This ever-increasing debt burden, coupled with a demonstrated reluctance to implement politically unpopular but fiscally necessary spending cuts, has led to speculation about the potential for the Trump administration to ultimately resort to unconventional and potentially destabilizing fixes should the debt burden become truly unsustainable. Several such funky ideas have been floated. The first, recently discussed, involves the removal of Federal Reserve Chair Jerome Powell and the appointment of a successor who would be pressured to aggressively cut interest rates, thereby artificially lowering borrowing costs for the government. However, this action would likely trigger a catastrophic market crash due to the perceived politicization of the central bank and the erosion of investor confidence in its independence. While Trump previously appeared to consider this option, the potential for severe economic fallout likely led to a swift retraction, although it might be revisited as a last resort. A second unorthodox proposal involves compelling nominal allies, particularly those reliant on the U.S. security umbrella, to purchase greater quantities of U.S. government debt. This concept has surfaced in discussions surrounding a hypothetical Mar-a-Lago Accord, where nations not meeting defense spending targets could be pressured to buy long-term U.S. military bonds. However, coercing sovereign nations into such financial arrangements is fraught with diplomatic challenges and could undermine international trust and cooperation. The third unconventional idea involves unilaterally extending the maturities on America's outstanding debt. This would entail refusing to repay bonds when they reach their original due date, particularly those issued when interest rates were significantly lower, and instead simply continuing to pay the previously agreed upon lower interest rate. While this would offer short-term savings by avoiding the need to refinance at higher current rates, it would constitute a de facto default and would catastrophically erode global confidence in the reliability and creditworthiness of U.S. debt, triggering a severe financial crisis with far-reaching consequences. While some legal interpretations might suggest this could be done without a technical default, the practical economic ramifications would be indistinguishable. In conclusion, any recourse to such unorthodox fixes would likely severely undermine global confidence in U.S. debt and precipitate a major financial crisis, inflicting significant long-term damage on the American economy. Therefore, the more prudent and sustainable path forward for the U.S. would involve the politically challenging but ultimately necessary steps of either raising taxes to increase government revenue or implementing significant and carefully considered cuts to public spending, mirroring the fiscal discipline often adopted by other advanced economies facing similar debt challenges.